Welcome back to Portfolio, everyone. And in this video, we're going to go over 6 stocks you should keep your eye on in the month of September. These companies operate in various sectors of the market, and this list has a lot of diversity, and a lot of these companies operate throughout the world and have revenue coming in from different countries across the globe. So we have a combination of both growth and dividend paying stocks on this list, and for each different company, we're going to do a quick overall analysis of the company, talk about some key points, and overall determine if we like the company, and just do a quick overview of each stock and describe why this one may be a nice buy in September. So we're going to jump right into the first one, but as you know everyone, I am the Gen Z investor, and every single day on this channel, we talk about different stocks you can buy, like we're doing today. We talk about different stock market news and headlines, and we just go over the entire market performance. We evaluate different companies and just see which stocks are great for our portfolios. So the first stock on this list today to keep your eye on in the month of September is Etsy, ticker symbol ETSY, currently around $119 a share right now. So this company has seen massive growth over the past 12 months, up 125%, and this company overall has been doing a great job of growing and expanding. So this is an e-commerce platform where individuals can sell homemade goods and services on their website. So this is not like the traditional Amazon or eBay. This is for more unique, creative, handmade products that can be shipped and sold all around the world. And why I like this company in the month of September is that people are still laid off. There's still a very high unemployment rate, and because of course, unemployment benefits aren't going out as fast as needed, people are looking for ways to generate some extra income. And it is very easy for individuals to start an Etsy store and sell their products and their creative designs online. So it's very simple to use, and Etsy is a company that for a lot of people and individuals who are at home, they can use it to generate some extra money. So Etsy has been performing great, and I believe this is a platform that will only grow as people become more entrepreneurial and people need to find new ways to generate some extra income. I think Etsy is a platform that will only grow over the next 12-24 months. And if we take a look at their stock, they are actually down from their peak a couple weeks ago. So from their peak at around $135, shares are currently down close to 12%. So this might represent a nice little buying opportunity during this slight dip that we're having right now. And if we take a look at Etsy's income statement, this company has been growing rapidly. Each and every year, you can see over double-digit growth in revenue. In the past 12 months, they've generated $1.12 billion in total revenue. And if we take a look at the graph, nice steady incline year over year in revenue. And overall, this is still a younger company. You can see here only $1 billion in revenue, but they are profitable. Over the past 3 to 4 years, they have been making profits each and every year, which is absolutely incredible. Especially for a young internet-based company where there's usually a lot of research and development costs, a lot of high operation costs, and they really don't post profits until like year 10 plus. Etsy's done a great job of producing profits over the past three years and growing them in the past 12 months. So Etsy's the first stock you should take a look at in the month of September. Stock number 2 has been making recent news headline as well, and that is ABBV, Abbott Laboratories, currently around $109 a share, up 32% on the 1-year chart. They saw the March lows but have quickly continued to grow and reach new time highs. If we take a look at the 5-day chart, you can see here a rapid surge in share price. Shares have jumped up from around $103 all the way around to $111, kind of trickling around that around $110 range over the past couple days. And what kind of led to that high growth was they announced that they have a rapid test to test for the potential virus that it only costs $5 and you can get your results in 15 minutes without requiring lab equipment. That is absolutely incredible. That is a game changer, and that is why I have this company on this list today. Because of this new technology, if this company can actually deliver, they're expecting to deliver 10 million tests in the month of September and hoping to get up to 50 million over the next few months. If they can do that, even though these tests are only costing $5, you may think per unit that's not a lot of revenue, but if they can expand their business, distribute these tests globally, there's billions of people who need access to this test, and I believe that's billions of dollars of revenue potential for this company. So their share price spiked when they saw this news come out, but it has been staying flat and actually a slight decline from where they peaked when that news came out. So this is a very interesting company because once they begin to roll these tests and these tests actually provide accurate results, this company may see a price surge throughout the month. If we take a look, they are a dividend payer, currently yielding around 1.29%, payout ratio around 44%, and they've done a nice job of growing their dividend at around 7.78% annually over the past 5 years. And if we take a look at their dividend safety rating, currently ranked 71, which is considered safe, which is a nice rating to have. Stock number 3 on our list today is a company that again has made a new headline. They have just been added to the Dow Jones Index, ticker symbol HON, Honeywell. Currently being traded at around $165 a share, and you can see here over the past 12 months, shares are up a slight 4%. And pre-pandemic high around $180 a share, this company actually hasn't recovered back to where they were trading before this pandemic and before the March dip in price. So this is a company that, once again, this may be a nice buying opportunity. They just got added to the Dow. They may see a surge in popularity because people now, talk with them a lot more because they're part of that 30 stock index, and they aren't even trading back where they were 6 months ago. On the 52-week range, you can see towards the high side, but nowhere near that 52-week high, a massive company with a market cap at around $116 billion, and they are a dividend payer. Currently yielding 2.17%, 52% payout ratio is extremely sustainable, and they've grown their dividend at a fast rate of over 13% averaged over the past 5 years, which is absolutely incredible. And they've been doing that for 16 consecutive years, which is incredible to see. With regard to dividend safety, ranked 99, the highest dividend safety rating possible. So this is a company where they're trading below pre-pandemic levels, been added to the Dow, a lot more popularity. They will be talked about a lot more in market news and headlines. Paying on a nice over 2% yield with a 99 dividend safety rating, this may be another one that could be a nice addition to your portfolio in the month of September. Stock number 4 is a very commonly talked about stock, but I like it in this month. Verizon, ticker symbol VZ, currently trading around $59 a share, up only 2.5% over the past year. So not a lot of price movement, which once again may make this a nice buying opportunity. You can buy the shares now at the same price they were being traded at 12 months ago. Of course, with a company like Verizon, you're not really here for the long-term share price rapid growth. You're here for some decent capital appreciation tied in with that nice dividend. Over the past 5 years, shares are up 29%, which is something to be expected. That nice average around about 5 to 6% annually over the past 5 years, for a total of around a 29% share price growth over 5 years, is very nice to see from a company like Verizon who's yielding over 4%. So this is of course a dividend play, a very nice dividend paying stock, currently yielding 4.14% with a sustainable, again, 51% payout ratio. This is a company where they're only paying around 51% of their earnings. They have a lot of money to stay within the business and expand operations, and they actually have a lot of room of growing that dividend year over year. And this is a cash cow company. This company's been around for a long time. This is in no way a growth company. They are using their cash very wisely, and they are in a very capital intensive business. So they don't really grow their dividend at a rapid rate. Annual dividend growth of 2.5% over the past 5 years, which is okay when you're getting a nice high starting yield of over 4%. And what that really means is your dividend is matching inflation each and every year, just so that even though your cash payments aren't getting a rapid growth, you're not actually losing money to inflation. Those yearly increases are keeping your income consistent year over year. And if we take a look at their dividend safety rating, considered very safe at 87, which is fantastic to see, especially when you're getting that massive over 4% dividend yield. Mega cap company with a $245 billion and an extremely low beta at 0.55, so not a lot of price movement with this company and more stability in your portfolios. Stock number 5 on our list is another boring one, but boring is good. It's nice to have some boring stocks in your portfolio. And that is ticker symbol UNP, Union Pacific Corporation, $192 a share, up 22% over the past 12 months. They've seen March lows and slowly but surely have continued to reach back around their pre-pandemic level. You can see here before the drop at around $185 a share and just over $192 right now. Very close to their 52-week high, and this is another massive company with a $131 billion market cap. Nice 2% yield, but before we go into the dividend, this is the type of company where you buy them today, you don't think about them for 10 plus years, and they will continue to operate. This is a slow and steady company. really across the country and across North America, they aren't really building more railroads. They aren't eager to expand the railroad network. So the companies that are on the railroad today, like ticker symbol CNI and of course UNP, these companies will continue to dominate that market for years to come. If we take a look at their 5-year performance, up 123%, which is absolutely incredible. And over the past 10 years, shares are up 427%. Long-term, consistent growth, this company's been operating for an extremely long period of time. If we take a look at the longest chart you can see on Seeking Alpha, beautiful, consistent, upward trend year over year for the past 30 years. Absolutely incredible. This is a company where you buy today, you hold in your portfolio for years and years, and you don't even worry about it. And if you take a look at their dividend, you're buying in today at a nice 2% dividend yield, 50% payout ratio, once again, extremely sustainable. Rapid dividend growth of over 14% average over the past 5 years is incredible, and they've been growing that dividend for 14 consecutive years. And with regard to dividend safety, currently coming in at 88, so another very safe dividend that is very unlikely to be cut anytime soon. Final stock on our list today is a high growth, rapid growth stock in the financial tech sector, which is ticker symbol SQ, Square, up 150% over the past 12 months, and currently being traded around $159 a share. You can see here they have been surging with the growth of e-commerce during this pandemic and people being forced to stay home. This payment software company, of course, has seen insane growth. Market cap at around $69 billion. Why I think Square is a buy this month is because I think this forced stay at home, and of course people are still staying at home. Companies are extending their stay at home work orders for another 12 to 16 months. And the fact that people are staying at home, they've been more comfortable with online shopping. Since they were kind of forced to transition to shopping online, people love it. They love the convenience of it, and they believe that they will continue to purchase items online that they used to purchase in stores. So that's going to be huge future market growth and revenue growth potential for a company like Square. I like Square over the next 5+ years. So of course we have to talk about today because before the holiday season, we're in September, holiday season's coming up. Of course, people start buying gifts in November and December. And I believe we will see a rapid surge and see record numbers with online purchases this Christmas season. And of course, this overall holiday season, because there's not going to be people packed into stores shopping last minute like we've seen throughout history, really. Now, with the limit of capacity within stores, forced social distancing, I really do believe that people are going to do most of their Christmas shopping and their holiday gifts purchases online, which is going to see rapid potential for Square, and I don't believe that's currently priced into the stock. And if we take a look at the company financials, this is another company that has been growing rapidly. Year over year, revenue growth is seeing double-digit growth annually, beautiful upward trend with total revenue, and this is a company that has been on a surge, and I believe that surge will continue. So those were 6 stocks you should take a look at in the month of September. So thank you for following along, everyone. All these stocks operate within different sectors of the market. They provide different value to investors, and they, of course, operate globally as well. So like and comment. Let me know down below if you are going to buy any of these stocks, and I'll see you in tomorrow's video.